Radhika Merwin, and this is a big picture on monetary policy. In today's session, we'll look at a monetary policy tool called the term repo, which was only recently introduced by the RBI. But before we understand the workings of the term repo, let us understand why the RBI found the need to introduce a new tool in the first place. There's usually a lot of fanfare around the Reserve Bank of India's monetary policy review. This is because this is the time when the RBI sets its key policy repo rate. As we know, the repo rate is the rate at which the banks borrow funds from the RBI for their short-term needs. So when the RBI reduces the repo rate, this leads to a fall in the bank's cost of borrowings and hence in lending rates. But sadly, this doesn't happen so in practice. Why? There are two main reasons for this. Banks borrow only a minuscule portion of their funds from the repo window. Hence, since they rely heavily on longer-term deposits, every time the RBI tweaks the interest rates, it does not immediately impact the bank's cost of funds. The liquidity situation also has a great impact on the pace of transmission. In a tight liquidity scenario, banks are not in a hurry to reduce rates. Every time the Reserve Bank of India reduces the repo rate, the banks need not reduce their deposit rates and hence lending rates. The RBI decided to address these issues by introducing the term repo. In keeping with the recommendations of the Urjit Patel Committee, the RBI introduced the term repo in October 2013. There were two main reasons for this. One, of course, to facilitate quicker transmission. And number two, the RBI did not want to provide funds to the banks at unlimited amounts at a fixed rate. So, the RBI introduced a series of measures. First, it capped the amount that the banks could borrow at the repo window to almost 0.25% of the deposits. It then provided liquidity at the term repo auction across tenures like 7-day and 14-day. But it provided these funds not at a fixed rate. The RBI auctioned such funds and the banks had to bid at the rate they were willing to borrow. By reducing and increasing the liquidity, the RBI has now ensured that the term repo rate moves in line with the policy repo rate. So have all these measures ensured quicker transmission? It is still early days to gauge the success of term repos, but the rationale is a sound one. By introducing term repo across maturities like 7-day, 14-day, 28 days, the RBI is ensuring to develop a yield curve across maturities. This can act as a benchmark to set the deposit and lending rates. The RBI can thus maintain a very strict vigil on both the deposit and the lending rates. By tweaking the liquidity at the term repo, the RBI can now set the interest rates. If it wants to increase the interest rates, it will tighten the liquidity. If it wants to reduce the rates, it will ease them up. The term repo rate is the rate at which banks borrow funds from the RBI for their short-term needs. But these are not fixed rates. Banks bid for them at the auction. In the next session, we will look at some of the preemptive measures like cash reserve ratio and statutory liquidity ratio.